blind stock analysis that's caused profit to jump.
I don't think it's software.
Okay, I have no clue.
Yeah, neither do I.
Oh, no! Damn it. Welcome to another blind stock analysis. This is a very popular thing we started a couple years ago, and it was initiated because I used to say we should look at companies without any biases about the business itself. Like, if you know, just to evaluate it based on the numbers. Right. Now, of course, there is a qualitative aspect to any business. You should have a bias towards businesses based on their quality components, but this allows you to take a financial numbers look at it and say what the things you think, and we want to try to guess which company it is based on the numbers. So
filter out all biases.
As many biases as we can. Okay, so we're going to start this, and Tim's here at the computer. He is going to put up some financials, and we're going to start talking through them.
Okay.
All right, so first screen, Tim has put it up. We're turning around here. Okay, no market cap, but we have an enterprise value of $37.3 billion. We have a small little dividend of 0.4, revenue of $6.3 billion. Now it's a big PE of 26, but a big 5-year. So something's happened in the last few years that's caused profit to jump. If you look at the profit margin, it went from 18.2 over the last 5 years to 22.
Price to sale almost 6.
Boy, look at this return on invested capital.
That's big.
And look at this chart going back to 1992.
Let's see here.
It's around $300 a share right now.
Okay. All right.
I love how Tim blocks all these out. We can basically understand it from the chart, but I understand completely. Year to date, it's up 17%.
I'm trying to think of companies that have ROICs that high.
Software, but this is kind of a low price to sales ratio for a software business.
I'm trying to figure out sector. I don't think it's software.
I mean, it's a pretty high profit margin. I don't know if it's software.
Can you show us the gross profit margin?
Well, no, he can't scroll down or else we'll see market cap, which I don't really care about the market cap.
Right.
I can figure out the market cap in like 14 seconds probably.
That's what I told Tim.
You can actually. You just take net income times PE.
See, I told you.
So the market cap, okay.
Next screen.
Next screen. Okay.
Revenue. Consistent growing revenue. No explosion through COVID.
Are you sure about that?
I mean,
yeah. Well, you're right. You're right. It's 4.1. It was actually even, and then
this was a big jump.
Okay, so what company would have been even for 3 years, even through COVID,
and then continued to grow?
Well, then not continue to grow, just like skyrocketed from there.
Net income.
That income's pretty substantially higher.
Yeah.
Okay, let's see other income expenses. Nothing major.
Can you scroll to shares outstanding? Oh.
We can figure it out.
I just really want to see.
Okay, buying back shares.
Buying back shares. Okay.
Okay, don't like that because the stock, well, it's 42.
I mean, based on PE that we saw, I don't necessarily love that.
Yeah. Okay, I have no clue.
Yeah, neither do I.
All right, go ahead, next screen. So here, Tim is, and now you're going to see which company it is, but Tim is sitting here and we're sitting there going $6 billion in revenue, profit margin about 18 to 22%, price to sales ratio around 5. Can we go to the next, can we look at the next screen? All right, the balance sheet. All right. Can you scroll down more, Tim?
Scroll down.
Total current assets about $1 billion. Scroll.
Keep going.
Current liabilities, 529. Total liabilities. Okay, so it's like that. That's the. Man,
I'm actually stumped. I usually have some type of guess at this point.
Well, so first off, let's talk about from the quantitative perspective. There's a lot of positives. High return on invested capital. Decent, good margin. Profit bottom line margin has jumped up from 18 to 22%. Debt is low.
Yeah, it's low.
However, that PE just bothers us. 42 on the 5-year PE, 26 on the 1-year PE. Go ahead.
Can we go to cash flow?
You want to go to cash flow?
Yeah, I just want to see the cash flow. Oh, wow.
Can you scroll down and see if we have any acquisitions here? Scroll down further. Up.
A little bit up. Yay.
Oh, there are no acquisitions.
Higher.
No, there are no acquisitions. It's in the investing section. I don't know why I told them to scroll up. Free cash flow. So no acquisitions, but some pretty decent capital expenditures.
What's market cap?
35 billion or so, roughly. Do you think you have an idea?
I just don't think it's in the retail space. That's the
problem. Oh, I don't think it's retail. That profit margin's too high for retail.
Yeah, I don't know.
Wait a second.
I mean,
I know it.
I have a guess.
I know it. Ferrari. Damn it. That actually seemed reasonable.
I think the PE's higher right now in Ferrari.
Is it higher than?
I think it is. I think. I could be.
Oh, you're right. No, I think you're right. You're right. But I looked at that going, okay, no acquisitions, big growth after, but I don't think Ferrari's revenue is $6 billion. It's a tough one.
It is.
Now, from the quantitative perspective, I don't like this. The PE is too high, even though there's a high return on invested capital. Can you justify 26? Is it a short term? You saw 3 years in a row about $4 billion in revenue, and all of a sudden jump up to 5.5 and $6 billion.
My guess was going to be Dick's Sporting Goods.
No, it's definitely not Dick's.
It's not retail.
Dick's does about $12 billion in revenue, and their profit margin is not
Definitely
20%.
Not. Yeah, I don't know. You completely stumped me.
What is it? $6 billion. Now, what's the next sheet? Anything else?
8 pillars.
Okay. Man, Mo, what is this? 36%. So I know it's not Ferrari now because Ferrari has 50% gross margin.
Pay a dividend.
Oh, yeah. I don't think Ferrari pays a dividend. The dividend's very low.
Yeah, it's very little.
Man, look at this return on invested capital.
I know,
right
it's
here.
insane.
5 years, 17%.
I don't know.
Is this? No.
You got another guess?
No, I got nothing. I was going to say a number. I was going to say a company that made absolutely 0 sense. I was basing it on the stock price because Microsoft hit about 3, like here, and then hit a low about 218 or 215. So I was like, is it? No, but the market cap of Microsoft is way higher. Man, this is a tough one. This is a very, 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 very tough one. Any other sheets to look at? No.
Help me.
I'm going to just hit this thing right here. See what it is.
Hit what?
Oh, no.
What is it?
Old Dominion. I thought, but
Never would have got that.
You know, I thought it. I was like, is it transportation? I'm like, no, it's not transportation because I would have
expected a fall in revenue.
That's exactly what I was like. Okay, 2020 would have had a fall in revenue that was significant.
That's impressive that they've continued to.
Yeah, but I don't think that's going to sustain.
No.
I don't think that revenue is going to sustain.
It hasn't fallen already.
So yeah,
they're still on the climb.
So after factoring that in, guys, I'm definitely avoiding this company. And the reason being is I think their revenue is going to fall because shipping was in high demand. Transportation was in high demand for all these goods.
Right.
I don't think that revenue is sustainable. And if it's already selling for 42 times 5-year PE, I'm avoiding. So I was already apprehensive. Then we found out what industry it's in, what company it was. I'm out. I'm going to wait for it to fall significantly.
Yeah.
But we're still going to do Stock Analyzer to see what we would pay for the company. So Tim is going to...
You're going to type it in for us?
Yeah. No, I'm going to do it myself. Okay. So let's do a 20, because Old Dominion's been around for a long time. So let's do our Stock Analyzer tool to look at what we'd pay for this company. I'm going to do a 20-year analysis. Mo's going to do 10. And remember, guys, this software... This Stock Analyzer tool is the most popular part of our site. It was used 1.3 million times in last year. And the reason it's so good is it allows you to make your assumptions about the future for whatever time period between 1 and 20 years. And it'll tell you what price to pay for the company based on these assumptions. Okay. So we're going to go put our assumptions in and then come right back and show you our numbers. Please hold. All right, guys, so here's what we did. Remember, we said that revenue was going to fall in the upcoming years. So we had to kind of extrapolate out. So my revenue growth numbers are going to be a little bit lower than what I would normally put if I thought revenue was going straight up from here. Because I don't believe revenue is going straight up from here. I think it's going to drop because it jumped up so much. Same with profit margin, same with returns, same with everything. PE. So I made conservative assessments. But again, I feel comfortable with that because I'd rather be more conservative, especially in the market we're in right now. A very euphoric market in an economy that's still booming, that hasn't seen a recession besides the government-induced COVID recession. So I look at this saying, I'm going to be conservative and I'll be fine with that. So Mo, on your 10-year analysis, what were your revenue growth numbers?
I did 4, 6, and 8.
On my 20-year, I did 2, 4, and 6% revenue growth.
Like it.
Okay? Yep. Profit margin.
13, 16, 19.
13, 15, 17.
Okay.
Free cash flow.
7, 9, and 11.
Whoa.
One lower.
Oh, wow, you did?
Yep.
Okay, I did 13, 15, and 17 again, but you're right, Mo. This was lower.
Yeah, it was a lot lower.
Oh, wow. Okay. PE.
15, 16, 17, also for price to free cash flow.
I did 13, 15, 17, factoring in the loss of revenue coming up.
Okay.
And then your return?
Return, I did 10, 12, and 14.
I did 11, 13, and 15. Again, guys, we don't know if these are the right numbers. This is the art of investing. The point is, this will help guide us whether it's overpriced or not. The stock's currently at 332. I hit the analyze button. My low price is 85. My high price is 122. So something tells me this is still way too expensive. Mo, what'd you get?
Yeah, so I'm all over because I changed the cash flow. 63 to 117, 85 to 150, 108 to 186.
So your highest price is 186, your lowest price is 65.
Yep.
Guys, I think this just screams it's overpriced, which is exactly what we thought. So we're going to hold off, and when they get a couple more years or a couple more quarters of information that we can go rely on, we'll reassess at that point.
Right.
$7, 7 days, everythingmoney.com. If you want the software, it's a no-brainer. It'll make you a better investor. Go sign up now. Thank you.